Welcome back to the channel. I am Algabot, and today we are studying an expert advisor for MetaTrader 5 called Settlement Pressure Continuation. This is an original, first principles system that reads nothing but raw price. There are no moving averages, no classic oscillators, and no chart patterns. Instead, it measures where each bar chooses to settle inside its own range, and how much energy that bar spent getting there. In the next few minutes, we will unpack the idea behind it, walk through the exact entry and exit rules, read the actual code, and follow a clear chart example. Remember, everything here is educational information only and never financial advice. Let us start with the big picture. Settlement pressure continuation is built from a single, simple observation. Most conventional tools look at how price changes from one close to the next. This strategy looks somewhere different. It asks, within each individual bar, where did price finally settle relative to that bar's own center? A bar that closes right at its high shows strong conviction from buyers. A bar that closes right at its low shows strong conviction from sellers. And a bar that closes in the middle, like a doji, shows indecision and should barely count. The clever part is the weighting. Each bar's settlement is weighted by its range, which is the distance from its high to its low. A wide, energetic bar that closes at its extreme carries a lot of weight. A narrow, quiet bar carries very little. When you combine these across a window of bars, you get a single, clean number the strategy calls settlement pressure. That value always sits between -1 and +1. Near +1 means closes are persistently landing high inside wide bars, which suggests a bullish order flow imbalance. Near -1 is the mirror image. Near 0 means the market is balanced and undecided. The core belief being tested is continuation. When participants keep pushing the close toward one extreme of expanding bars, that imbalance tends to persist for several bars before it neutralizes. So this is a momentum-style, continuation approach, not a reversal approach. It is designed for traders who like a rules-based, fully mechanical system and who want to understand the logic under the hood rather than rely on a black box. It reads only the primary time frame you select, and nothing is hard-coded to a particular symbol. So the same rules can be studied across many markets. As always, trading involves risk, and losses are a normal part of any strategy. Now let us walk through the mechanics step by step. On every newly closed bar, the strategy computes settlement pressure, which it calls P. For each bar in the window, it takes 2 times the close, minus the high, minus the low. It adds those up across the window, then divides by the sum of all the bar ranges. Because the ranges appear on both the top and bottom, they cancel cleanly, and you are left with a dimensionless value between -1 and +1. The default window is 20 bars. For a long entry, 3 conditions must all line up. First, the magnitude gate. P must reach the entry pressure threshold, which defaults to 0.30. Second, the acceleration gate. P must be more extreme than it was a set number of bars ago, 3 by default. This clause demands that the imbalance is actively strengthening, not stale. Third, the confirmation gate. The last closed bar itself must have settled above its own midpoint, meaning 2 times its close minus its high minus its low is positive. When all 3 agree, the strategy signals along. A short entry is the exact mirror. P must fall to the negative threshold. It must be falling compared to a few bars ago, and the last closed bar must have settled below its own midpoint. When those align, the strategy signals a short. Risk is self-adapting. The strategy computes its own volatility as the mean raw bar range over the range period, 14 bars by default. The stop distance is that volatility multiplied by the stop multiplier, which defaults to 2. So in calm conditions, the stop is tighter, and in faster conditions, it widens automatically. The take profit is the reward risk multiple times the stop distance. With the defaults, the target sits at twice the risk, a reward to risk of 2 to 1. Finally, there is a dynamic exit that sits on top of the fixed stop and target. The instant settlement pressure crosses back through 0. The edge that justified the trade has neutralized, so the strategy closes the position early rather than waiting for a fixed level. It holds only one position at a time for its magic number. Every one of these numbers is an adjustable input, so the behavior can be studied and tuned in the strategy tester. Here is the heart of the code as you would read it in MetaEditor. At the top are the inputs. Window is the number of bars in the settlement pressure calculation. Entry pressure is the magnitude gate that P must reach. Confirm bar sets how far back we compare to prove acceleration. Range period drives the self-computed volatility, and stop multiplier turns that volatility into a stop distance. Reward risk sets the target as a multiple of the stop, and lots is the trade size. Just below, the code reads the last closed bar and forms its settlement sign, 2 times close minus high minus low. Then it builds the two Boolean signals. The long signal is true when P is at or above the entry pressure, when P is greater than its earlier value so it is rising, and when the last bar settled above its midpoint. The short signal is the exact opposite on all 3 checks. If the long signal is true, the entry is taken at the ask. The stop is placed 1 stop distance below entry, and the take profit is placed reward risk times the stop distance above entry. Then trade up by sends the order. If instead the short signal is true, the entry is taken at the bid, the stop is 1 stop distance above, the take profit is reward risk times the stop distance below, and trade.sell sends that order. Both sides use the same self-sizing logic, mirrored in direction. Let us walk through this chart candle by candle. In the lower panel, you can see the strategy's own creation, settlement pressure, which we call P. It swings between -1 and +1. The dashed green line marks the long threshold at +0.30. The dashed red line marks the short threshold at -0.30, and the gray line in the middle is 0, the neutral level where the edge is considered gone. Look at the first 3 candles. Price is drifting sideways, and the bars close near their middles, so P hovers just around 0. There is no conviction yet, and the strategy stays flat. Then watch the third and fourth candles. They widen out and close right up near their highs. Because P weights each bar by its range, these energetic bars closing high push the pressure reading up quickly. By the fourth candle, P has climbed above the +0.30 threshold, and just as importantly, it is higher than it was a few bars earlier, so it is accelerating, not stale. On top of that, the last closed bar settled above its own midpoint. All 3 conditions agree, and the buy entry marker appears. Notice how the stop is sized. It is not a fixed number of points. The strategy measures the mean range of recent bars and multiplies it by the stop factor, placing the protective stop a set distance below entry, tuned to how much this market has been moving. The take profit sits at twice that distance, reflecting the reward to risk of 2 to 1. Now follow the next 3 candles. Buyers keep settling price near the highs. The bars keep expanding upward, and P pushes toward its peak near +0.6. Price runs cleanly into the take profit target, and the long is booked at the take profit marker. Remember, there is also a dynamic exit in the code. Even if the target had not been reached, the moment P fell back through the 0 line, the strategy would have closed the trade because the settlement edge would have neutralized. Then the character of the market changes. On the 8th and 9th candles, the bars start closing near their lows instead of their highs. These wide bars settling low drag P downward fast. By the 9th candle, P has dropped below the -0.30 threshold. It is falling compared to a few bars back, and the last closed bar settled below its own midpoint. The mirror image of the long is now in place, and the sell entry marker prints. The stop is placed a volatility-based distance above entry, and the take profit target sits twice that distance below. From there, sellers stay in control. Each of the following candles closes near its low, P deepens toward -0.5, and price slides down into the short take profit target, where the trade is booked at the final take profit marker. By the last candle, price steadies and P begins drifting back toward 0, telling the strategy the imbalance has cooled and it should wait for the next clean setup. That is the full cycle, a continuation long and a continuation short, each driven entirely by where price chose to settle inside its bars. So there you have it. Today we studied settlement pressure continuation, an expert advisor that ignores traditional indicators and instead reads where price settles inside each bar, weighted by that bar's energy. We covered how it builds its settlement pressure value, how the magnitude, acceleration, and confirmation gates align a long or a short, how it stops self-size to recent volatility, and how the dynamic zero cross exit steps in when the edge fades. Everything we discussed is for educational purposes only and is not financial advice, a recommendation, or a solicitation. Trading carries real risk, and losses do happen. If you found this analysis helpful, please like the video, leave a comment with the strategy you would like me to break down next, and subscribe for more MetaTrader 5 strategy studies. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.